Let's be honest, if the thought of doing your taxes makes your head spin, you are definitely not alone, but you're in the right place. We're about to slice through all that confusion and really build a solid understanding from the ground up. By the time we're done here, you're going to see the US tax system not as some big, scary mystery, but as a puzzle you can actually solve.
Okay, so let's just jump right in with the big question, the one that really gets this whole thing started. How does the money you work so hard for, the money in your paycheck, actually, turn into the final tax bill you owe? That is the journey we're going on today, and I promise we're going to map it all out, step by step.
So here's our game plan. We're going to start with the big why. Why do we even have taxes? Then we'll get into the real nitty-gritty of how your bill is calculated. After that, we'll unpack two of the most powerful tools in your entire tax toolkit, deductions and credits. We'll also look at how different kinds of income get treated differently. And then finally, we'll put it all together so you can start thinking about your very own tax plan. Sound good? Let's do it.
All right, first things first, before we even look at a single number, let's talk about what taxes fundamentally are. At its heart, it's really just the way we all chip in to pay for the country we live in. It's not just money vanishing into thin air. It's what funds our shared society.
I mean, just think about it for a second. The public schools our kids go to, the postal service that brings mail to your door, the police and fire departments that keep us safe, even the military that protects the entire nation. All of these are public services, and we pay for them indirectly through our state and federal taxes. So how does the government decide who pays what? Well, the US uses something called a progressive tax system, and it's all built around this core idea of fairness. The more money you make, the higher your tax rate becomes. This is the complete opposite of a flat tax, where, a billionaire and a barista would pay the exact same percentage. Now, this next part is what trips a lot of people up. A progressive system uses tax brackets, but honestly, I think it's way easier to think of them as buckets. As you earn money, you start by filling up the first bucket, and that bucket is taxed at the lowest rate. Once it's full, any more money you earn spills over into the next bucket, which has a slightly higher rate, and so on. So this is key. If you earn, say, $100,000, you are not paying your highest tax rate on that entire amount. Not even close. This chart here shows you exactly how those buckets work. See that first bar on the left? Everybody, and I mean everybody, no matter how much they make in total, pays just 10% on their first chunk of taxable income. Once that bucket's full, any additional money spills into the 12% bucket. Your income has to completely fill up these lower rate buckets before a single dollar gets taxed at your highest personal rate. That's the progressive system in action, right there. All right, so now that we get the why and the basic structure, let's get into the how. Calculating your tax bill is basically a formula, and the single most important phrase you need to tattoo on your brain is taxable income, because it's not your total income, it's the income you have left after you take some really important deductions. This little flowchart shows the whole journey, from your paycheck to your final tax bill. See? It all starts with your total income, but you don't pay tax on all of that. No way. First, you subtract deductions, and that shrinks the number down to your taxable income. That's the number the tax brackets actually apply to. After you do that math, you get your tentative tax. But wait, there's one more amazing step. You subtract your credits. And what's left over? That's your final bill. So let's break down those two key players, deductions and credits. Okay, so what in the world are these deductions that lower your income? Well, to make life easier, the government gives almost every taxpayer a default choice. It's called the Standard Deduction. Think of it as a no questions asked, fixed dollar amount you get to just subtract from your income right off the bat. The exact amount just depends on your filing status, whether you're single, married, or the main provider for your household. Let's look at some real numbers from 2022 just to see how powerful this is. A single filer got to deduct nearly $13,000. So imagine you're single and you earned $40,000. Your tax isn't calculated on that full 40 grand. Nope. Instead, you subtract that deduction and you're only paying tax on about $27,000. That is a huge, huge difference. And it happens before those tax buckets even come into play. Okay, this brings us to what might be the single most important concept in all of taxes, the difference between a deduction and a credit. They both save you money, for sure, but they do it in totally different ways. And trust me, understanding this is the key to getting a real handle on your tax situation. So here's the absolute crucial point. Write this down. Deductions reduce the amount of your income that's subject to tax in the first place. They get applied before the tax math even happens. Credits, on the other hand, are way more direct. They are a dollar-for-dollar reduction of your final tax bill. They get applied after all the tax has been calculated. Let's make this super real. Okay, imagine you get a $1,000 deduction. If your highest tax bracket is 22%, that deduction saves you 22% of $1,000, which is $220. Now, that's great. It means $1,000 of your income isn't getting taxed at that high rate, but you don't save the full $1,000.
Now, let's compare that to a credit. A $1,000 tax credit is literally like having a $1,000 gift card to the IRS. If your tax bill was calculated to be, say, $5,000, a $1,000 credit slashes it directly to $4,000. Boom! It just wipes out $1,000 of tax you would have had to pay. And that is why tax credits are almost always more powerful than deductions.
All right, let's add one more important layer to this. It turns out that not all money is created equal, at least not in the eyes of the tax code. Where your money comes from, whether you physically worked for it or your money worked for you, can have a massive impact on the final tax you pay. So on the left, we have earned income. Pretty straightforward, right? This is money from actively working, your salary, your wages, tips, business profits. Then on the right, we have what's called unearned income. Now, despite that name, you still earned it, but it's money that your money makes for you. Think stock dividends, interest from a savings account, or income from a rental property. So why does this matter so much? Well, the biggest reason comes down to payroll taxes. Your earned income, your salary, gets hit with income tax plus taxes for Social Security and Medicare. But unearned income, that investment income, it doesn't. On top of that, profits from investments, especially things you've owned for more than a year, are often taxed at special lower rates. These are called capital gains rates, and they're almost always lower than the tax rates on your salary. And this all points to a bigger philosophy that's kind of baked into the tax code, which one of our sources just summarized perfectly. The ultimate goal is to go from employee to investor as quickly as possible, because the system favors investment income. Shifting from relying only on a salary to building streams of unearned income, well, that's not just a wealth-building strategy. It's also a tax-saving strategy. So, we've covered the why, the how, the power players, and the different types of income. So now what? Well, now we take all this knowledge and we make a really important shift. From just reacting to whatever tax bill you get once a year to proactively planning for it. This is where you really start to take control. Here is a super simple framework to build that plan. It all starts with knowing the basics we just talked about. What are your tax brackets and what tools do you have, like deductions and credits? Once you have a handle on what your likely tax bill is, you can start to choose a strategy that fits your goals, like, say, maximizing retirement contributions to get a bigger deduction. But look, the most important step here is the last one, actually putting that plan into action. And you know what? If you have followed along this far and you understand these core concepts, from the progressive buckets to the power of a credit to the different types of income, then seriously, congratulations are in order. You've done it. You have officially graduated from the beginner stage. You now have the foundational knowledge to think about your taxes strategically. So I'm going to leave you with this final thought. A tax return can be something that just happens to you every spring, or it can be the result of a smart plan that you put in place all year long. It's not just a bill, it's a reflection of your financial strategy. And now that you know the rules of the game, there's really only one question left. What's your plan going to be?